Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Brian Madden is on the show today. He is Chief Investment Officer at First Avenue Investment Counsel, and he will be taking your questions on North American Equities. So here's how you can reach us. You can call us toll free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. Brian, of course, joins us in studio. It's good to see you.
Likewise. Thanks for having me.
Yeah, it's been an interesting week, and we're watching the markets kind of extending that AI sell-off today. What do you make of what you're seeing? Do you think it's all a little overdone at this point?
Great question, Lindsay. And it is the $64,000 or maybe $64 trillion question investors seem to be grappling with this year and really for much of the past 3 months. So the answer is, in all candor, we don't exactly know. But what we do see is markets starting to price some two-way risk around the AI theme, whereas previously from its inception, which you can roughly date back to when ChatGPT went live in November of 2022, through to about November of last year when Michael Burry of the Big Short fame sort of sounded the alarm about concerns about circular financing and maybe overbuild in the AI and data center space. It had really been sort of all one way, all in on anything that looked, smelt, or felt like artificial intelligence. But now you're starting to see markets sift and sort and parse winners from losers. And in particular, what we have seen really quite a lot of since November and accelerating this year is this sort of sell everything that could be disrupted by artificial intelligence, notably software stocks, but really you could extend that out to white-collar employment in all its forms, rippling into engineering and construction and IT consulting and the like. So for us, we were never really all-in AI cheerleaders, nor were we Luddite skeptics, but rather we think you should take a nuanced case-by-case and company-by-company approach to sort of pricing AI risks and opportunities. And so we are starting to sniff out some opportunities in the sort of baby thrown out with the bathwater category lately.
And so, yeah, because you say you've taken profits in semiconductor designers in recent months, is that where you're looking at opportunities where AI might help some of these companies rather than disrupt them?
Well, certainly.
You don't know yet.
We think that it will help them. And so, I mean, the analogy that people often use, and I hate to trot this one out because it's so well worn and well tread, but it's the selling shovels and pickaxes to the miners in the gold rush. So certainly on the front end of the trade has been the semiconductor designers and the foundries that manufacture for them. So the likes of your NVIDIAs and Broadcoms and TSM, Taiwan Semiconductor. So we own those, have owned them for a long time. We've taken partial profits in a couple of those. But the picking up babies thrown out with the bathwater, an example would be Shopify, which we've owned for years. Sold off a lot. We added to it in our momentum mandate, a couple of weeks ago. So there's going to be winners and losers. There's going to be business models that are enduring. And so, as much as we thought it was very implausible that something, a technology as purportedly disruptive as so many believe artificial intelligence to be, could go on for 3 years without anything, no one and nobody seemingly being disrupted. So, we are seeing evidence of some companies' business models being on shaky ground, but others we think are getting unduly sold off because we think their business models will prove to be resilient and in fact enhanced by AI rather than disrupted by it.
Okay, it's obviously for sure an ongoing conversation. We're going to take a quick break right now, though. We'll be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities right after this. Stay with us. Welcome back to Market Call. Brian Madden is on the show taking your questions. We're going to start with an email question from Corey, and it reads, what is your opinion on Propel Holding? Good time to enter for a longer term hold. So yeah, Propel Holding, what do you think about the company right now?
Yeah, thank you for the question, Corey. So this is an interesting one. We're a bit tossed up about it. We don't own it. It's certainly not a household name, but for context for viewers who may not be familiar with it, It's a fintech, and it's an alternative lender. Some might categorize it as micro lending. I think a good way of conceptualizing this company is a digital alternative to payday lenders. Maybe the company would bristle at that categorization, but it sort of situates itself somewhere between prime credit lending, as in what the big banks do, and your money marts and your other payday lenders. But it's AI enabled and digital, so a disruptive fintech. Interestingly, it's a 2021 IPO, and I hate to paint the whole crop of 2021 IPOs with the same brush, but many of them were kind of shaky. That was the era of the SPAC, Special Purpose Acquisition Corp. So this is not one of those. This is an operating company and always has been. It's been operating in the United States since 2011. It operates in Canada and in the United Kingdom through a variety of different banners, I should say. It trades at a discounted valuation, about 6.5 times earnings. So on the surface, you'd compare that to, say, a bank, and you'd say, well, it looks cheap. It also yields about 4 point something %, which is pretty comparable, competitive with the banks. Now, here's the big difference. This is a lender that charges, you might say, usurious interest rates to people with low credit scores or no credit scores. And the way it adjudicates credit is using AI markers, so employment history, income verification, transaction history, and other patterns of consumer behavior. And that's their way of sort of scoring and adjudicating credit. It's all digitally done, so credit decisions are made quickly. They run a loan book of about $550 million, but here's the rub. The credit loss experience is very high. So roughly, the allowance for credit losses is roughly half of the whole credit book. So for context, the banks, across their whole portfolio of loans, it's usually somewhere around 0.7 to 0.8, 0.9, sometimes 1%. So these are not good credit borrowers. The company, their narrative is that they're helping them graduate into prime lending. So that's why we're a bit wary about it. We would also note there is very, very limited institutional participation in this. Only about 17% of the shares are owned by professional investors. So it's kind of a retail name. It's well liked by analysts, though, 8 buys, and it has been growing profitably. So on the one hand, you want to like it. On the other hand, we're a bit wary, and so and we're also mindful of the fact that because it's digitally enabled and it's sort of connected to AI, it may be that there are low barriers to entry, and other digital disruptors could come and eat their lunch, so to speak. So we haven't gotten involved, but an interesting one to sort of keep on the radar and watch.
For sure. Okay, we're going to go to the phone lines now. Frank is calling in from Toronto with a question. Hi, Frank.
Hi, Lindsay. Hi, Brian. I have a question regarding South Bow Corporation. I received it from a spinoff from TC Energy, and I received some shares. Also, I added to my position a little while back. It's kind of been a stock under the radar, so to speak. I would like Brian's opinion and thoughts on this company now and moving forward.
Okay, thank you for that. Looks like it's had a good year so far, at least this year. What do you think?
It has, yeah. Thank you for the question, Frank. So we also were shareholders in South Bow, and it originated in the same way as it did for you. We were shareholders previously in the former parent company, TC Energy, and then they spun South Bow off in, I think, the fourth quarter of 2024. And so having done a lot of research and read some academic work on spinoffs, there tends to be a bit of a market anomaly that allows them to, for the most part, outperform in sort of the first year of seasoning on their own as independent public companies. So we held the shares post the spinoff. They traded down initially. And so just as a reminder to viewers, TC Energy is the big natural gas pipeline operator down through Canada and the United States, and also has power generation through interests in Bruce Power and so on and so forth. And they had previously owned South Bow, which was a network of oil pipelines. And there was a hue and cry to spin it off, thinking it was undervalued because it was, quote unquote, dirty oil in a company that had otherwise hitched its fortunes to the future of clean energy, notably nuclear, Bruce Power, and natural gas. And so it was unduly discounted. So we continue to own TC Energy. we rode South Bow for a while. I think we sold it around $38 or $39, and it wasn't really, on any fundamental concerns about the business. It's just that the mandate that we owned it in is a dividend growers mandate, and the prospect for dividend growth at South Bow is pretty meager. They're not going to see a lot of volume growth on their pipelines. And we thought the re-rating was, by and large, complete after its season for a few quarters as a public company and rallied up to 38 or 39. We might have been premature, and tip of the hat to you for continuing to ride this one. But I would say have an eye to the valuation. It's not just always and everywhere about what is the yield. The yield is juicy on this, but you have to take the total return into consideration. And if there's limited growth for prospective dividend increases in a 5 or 6 or whatever percent yield it offers now might not be compelling in a total return sense relative to other income generating alternatives, like, for instance, TC Energy, which we prefer better.
Okay, I think we have time for one last question here in our last minute. Bill's calling in from Bowmanville, Ontario, with a question. Hi, Bill.
Hi. Thank you for taking my call. I'd like Brian's thoughts on Vistra and what does he see for the next few years with his stock? Thank you.
Okay, thank you.
Great, thanks for the question, Bill. So we actually own Vistra. This is a big U.S. Electric utility. We own it in our Momentum mandate. We originated the position just about a year ago, I want to say. And the thesis ingoing and ongoing was that demand for power outstrips supply in the United States for all kinds of reasons, most notably the massive build out in data centers. We think Vistra is well positioned. They've got a few merchant power generating businesses where they're exposed to spot markets for electricity, but a lot of it is contracted and so on and so forth. Their footprint is pretty good. They're big in the what the U.S. energy regulators call the PJM region, which is Mid-Atlantic, Pennsylvania, Maryland, and where Data Center Alley is. And they're also in the Epcot region, which is Texas, which is an unregulated market where power prices can go hog wild over the moon, as they sometimes do in big storms and heat waves and whatnot. They also have a very good nuclear energy fleet. We think the future of power generation necessarily is going to be nuclear and natural gas, particularly to feed data centers, because they need always on power, and intermittent sources like renewables, wind and solar just don't cut it. We also like that they're signing power purchase offtake agreements with some of the big hyperscalers. So we think the pullback is viable here. And I would note they also just reported first quarter results, which were kind of mixed, but the outlook we think remains pretty good for Vistra going forward.
Okay, we're going to take a quick break right now. We will be back, though, with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities right after this. Stay with us. Welcome back to Market Call. We're going to go straight to the phone lines for a question for Brian. And this is Tony calling in from Toronto. Hi, Tony.
Good day. I'd like your advice on the situation in Iraq and the U.S. to do with the oil industry. The U.S. ambassador in Israel today advised his non-essential staff that they should evacuate today from Israel and not wait until tomorrow. People are anticipating there might be a war starting tomorrow. If that does happen, what does our guest think will happen to the oil? And oil might be disrupted from coming through the Straits of Hormuz. What does the guest think about what will happen to the price of oil, and which company would you recommend that we purchase oil if we wish to buy the shares?
Okay. Thanks, Tony, for that. Yeah, I mean, it's a concern of many right now when you look at oil and what's happening between the U.S. and Iran and all the tensions in the Middle East. What do you think about that? And then we'll get to maybe some companies you think are safe to invest in.
Yeah, and I think that's a good way of framing it, Lindsay. Thank you for the question, Tony. So first, right off the hop, we don't have a red phone to the Pentagon, so we don't know exactly what is planned, but we do know that the U.S. administration did strike Iran last year, a targeted strike to disrupt their nuclear weapons enrichment, uranium enrichment facilities, and they've been making noise about to the effect that Iran is firing that up again. We also know that they have marshaled a few fleets of aircraft carriers and other battle group to the region. So it wouldn't be terribly surprising if there were to be hostilities there in the near term. We think that that is being priced in the commodity pits. I was looking earlier this morning, oil was up something like $4, or maybe it was 4%, but in any event, a significant move for the commodity. And it's roughly traded up about $10 or so or more year to date. And we think a lot of that is pricing in geopolitical tension, because absent the geopolitical tension, the oil market is pretty well supplied. So, you know, risk management or opportunity management is about probability and severity. So the probability of a strike seems to be increasing. What we don't know is the severity, and in particular, we don't know to what extent Iran will respond in a scorch the earth kind of a way, which they didn't do when they were struck at their nuclear enrichment site last summer. They sort of made a symbolic counterstrike, but gave the U.S. a courtesy call when they struck, I think, a base in Iran so that they could evacuate. So that was the safe face internally. But the scorch the earth, you know, counter move would be to attack oil production and oil infrastructure in the surrounding countries in the region, which could really disrupt the oil, the global oil supply-demand balance, which could cause oil to really skyrocket. I would say, you know, geopolitical tension tends to be sharp and fleeting. So we saw oil spike something like $10 when the situation in Gaza broke out a few years ago. We saw it spike when the U.S. struck Iran last year, but it quickly cooled back down and reflected supply-demand fundamentals. So the fact or the absence of U.S. action in Iran shouldn't be the underlying reason why you include oil in a portfolio. And moreover, if you're investing in oil-producing equities rather than just the commodity, the company you choose should have something going for it other than just a commodity tailwind. So for us, we do have positions in the energy sector. You know, we own a Canadian nat gas producer that would obviously not at all be advantaged by tightness in the oil market if Iran were to be struck. But the underlying fundamentals we think are good there. And then for oil exposure, primarily we own ExxonMobil, which has a lot of self-help catalysts, internal cost takeout programs, and pretty compelling organic growth prospects, notably with their production in Guyana, which previously didn't really produce any oil to speak of, but has been the fastest growing economy in the world for the last 3 years because they have found this massive offshore oil field, which ExxonMobil is involved in. So that would be the way we would get involved in the situation. But the caveat here is we really don't know how this is all going to play out in the Middle East in the coming days and weeks, frankly.
Okay, I think that answered all of the points of Tony's question. Thanks for that, Tony. We're going to go back to the phone lines. Larry's calling in from Toronto with a question. Hi, Larry.
Hi, Brian and Lindsay. Thanks for taking my call. Brian, a few months ago, you said you'd be a buyer of Fairfax Financial, and I think we know that it's been downgraded by BMO recently, and I just wonder if you'd still be a buyer of it and if you own it. Thanks very much. Appreciate it.
Thank you.
Yep, thanks for the question and good memory, Larry. We did talk about this a couple of appearances ago. We continue to own this stock in our Momentum mandate. They just reported their fourth quarter results last week. The results were very good. Their earnings were stronger than expected. Their underwriting was fantastic. Their combined ratio, which is basically their operating costs relative to their premiums written, was something like 88 or 89%. So that's very strong results for any property and casualty insurer. And really what it speaks to is there was a dearth of big catastrophe losses in the fourth quarter. But taking a longer view, this is a company that's gotten much better and more disciplined in underwriting for pretty much a decade, and you see that reflected in the share price. We still think there's a good line of sight to about $4 billion in earnings for the foreseeable future, courtesy of strong underwriting, organic growth, and just the carry on their big $60 billion float, which is the sum of their reserves and surplus on the insurance portfolio. So yeah, we like this stock, and Also would note that it's in the news again this morning. So this is a bit unlike a lot of other property and casualty insurers that are just passive investors in stocks and bonds and alternative assets. Fairfax is a bit like some people call its chairman and founder, Prem Watsa, Canada's Warren Buffett. So they buy whole companies. You know, they own Recipe Unlimited, they own Sleep Country, they own, it used to be called Bauer, it's the hockey equipment company, and various other things. And they're in the hunt for an $8 billion banking acquisition in India. And they have a big footprint in India already, and in that region, they own the Bangalore airport. So it's a region they know well. It is very, very dynamically growing economically. So, you know, we'd give them better than even odds of getting this one over the line, and it would probably be another nice trophy asset to add to their growing portfolio of owned and controlled companies.
Yeah, it looks like they're in the top run for that right now. Anyways, okay, we've got one more question before we have to take a quick break. So Elliot calling in from Hamilton with a question. Hi, Elliot.
Good afternoon. Service Corporation International has reported a couple of good quarters, and it reports that things are normalizing after its COVID experience. I'm not looking for a home run. I'm looking for something that's going to hit me some nice steady singles in my RRSP. Do you think SCI might qualify? Thank you.
Okay, thanks for that question.
Thank you, Elliot. Yes, we do. In fact, I think the last time I was on the show, I had identified this as one of the top picks. They have reported a few good quarters in a row, and as you noted, they had, let's call it euphemistically, tough comparisons from about 2022 through 24, mid-2025. And I say euphemistically because what happened during COVID is demand got pulled forward. In other words, there were a lot of premature deaths that caused their business to surge. They own and operate over 1,000 funeral homes and cemeteries in the US and in Canada. So this is not going to be a home run. This is a good way to sort of add some ballast to a portfolio because death and taxes, as we all know, are inevitable. So this is a business that, to state the abundantly obvious, serves a need and not a want. It is the dominant operator in a fragmented industry. It's a serial acquirer, sort of rolling up these mom and pop operations in cities and towns all over the United States and Canada. Financially strong, very capable, and scale and scope advantage. So a very good and solid choice for singles and steady income and a growing dividend, which is why we own it in our dividend growers mandate at First Avenue Investment Counsel.
Okay, great. We're going to take another quick break right now. When we come back, though, we'll take a look at some of Brian's past picks. So that's next. Stay with us. Welcome back to Market Call. We're going to go through some of Brian Madden's past picks now. So these are from February 28th, 2025. So we'll start with TFI International. It was at $131.20 when you recommended it. Now at $161.46. Done pretty well.
Yeah, so we continue to own this. In fact, we've added to it since we identified it as a top pick last year. What a difference the year makes. It's still well off of its all-time high, reached 7 or 8 quarters ago, but recovering nicely. And it was a little bit tainted when we talked about it a year ago. It had just come through this kerfuffle, let's say, of announcing their intention to re-domicile the business to the United States, which could not have come at a less timely juncture, right, in the heat of the Trump inauguration and the tariffs and everything else. But really, to their credit, the management team retrenched after they got an earful from some of their major shareholders and sort of rolled back that decision. And in the background, or I should say in the foreground, it's a trucking, less than truckload, and an asset-light logistics business. It's been battling through what is probably the longest manufacturing and freight recession, certainly in my investing career, and if not my lifetime. Manufacturing was shrinking in the United States for, I think, 35 of the last 37 months. It just turned the corner last month. So obviously, if manufacturing is in contraction, all those goods don't need transportation. So it's been a weak demand backdrop, which has pressured their growth and their margins and profitability. But they've taken some steps to, enact self-help. They changed out the leadership of the LTL, less than truckload division. So we now think they have very easy earnings comparisons ahead. They're running leaner. They always ran lean, but even leaner still. And so we think they're going to have very dynamic earnings growth in the coming 2 or 3 years. And we think the shares don't reflect the full value. The company agrees, and they're buying back their own shares hand over fist rather than allocating capital to acquisitions, something that they do prolifically. They've done something like 80 acquisitions over the last 10 years. So that is a strong signal when a serial acquirer says the best value in the market is not competitor XYZ, but it's our own stock. We sit up and take notice. So continue to be long and strong this name.
Okay, next one is Alamos Gold. So recommended at $33.06. It's now at $72.97. Total return so far of 121%. Maybe not a surprise with a gold producing company that they've done so well, but you still holding this one?
Yes, we are. So we own this in both our momentum and dividend growers mandates. So obviously we're very pleased with how it's performed. As you noted, Lindsay, the commodity gold bullion has been a rocket fuel tailwind to their earnings and cash flows, and obviously their share price as well. But beyond that, we like the assets. There are Mulatos mine in Mexico, Island Gold, and other mines in Canada. Key being these are safe mining jurisdictions, and I realize that might sound a bit at odds with what we're seeing on the ground with Mexico kind of up in flames just a few days ago. But that skirmish we think is probably isolated, and it doesn't seem to be of great impact to this mine, which they've been mining for 20 plus years. So good organic growth production out to 2030, strong and well-entrenched management team, good governance, and I think fairly undemanding valuation still, even though it's run up a lot in the last year, just given how prolific their free cash flows are going to be at, prices for gold north of $5,000 and seemingly climbing.
And still, you expect more of a run to come for Alamos Gold.
Yeah, gold, when it moves, it makes big, epic, historic moves, and it's in the throes of just such a move right now. So. So we continue to be bullish on gold. It's an anti-dollar trade. The dollar is broadly weak, benefits from lower interest rates. Interest rates are going down globally, and it benefits from foreign central banks diversifying out of all things U.S. dollar, whether treasuries or T-bills or what have you, and accumulating gold. And they've been doing that for 2 or 3 years ever since Russia invaded Ukraine. So a lot of good things happening here at the macro and the micro level. So we continue to own this.
Okay, lastly, Nutrien. So recommended at $75.82, now at $99.90. What about this one?
So we continue to own this one. We own this in our dividend growers mandate. The yield, I think, is about 3.5% or so. They made a modest increase to their dividend when they reported their fourth quarter results. We think there's capacity to do more. Make no mistake, this is a cyclical company. It's 3 upstream crop nutrient businesses, potash, nitrogen fertilizers, and phosphates. Of those, potash is the most important, followed by nitrogen, and phosphates is a bit of a rounding error, and it may be deemed non-core, so they're looking at strategic options for that phosphate business. We'll see what decision they come to there. And then what really smooths out the raw cyclicality of the upstream crop nutrient divisions is the downstream integration. So they have about 2,000 or so farm supply stores all over Western Canada, the US, South America, and Australia, where they sell their own product and third-party product, and are really closely allied with the farming and growing community. So we like the mix of businesses here, and we note that we bought it when we thought the cycle was troughing. Recall this went on a moonshot in 2021 and 2022 when Russia invaded Ukraine and became subject to sanctions that really tightened up the market for a lot of these fertilizers, which obviously, again, are needs, not wants, if you want an economically viable crop in your field.
For sure. Okay, we're going to take another quick break right now. We will be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities right after this. Welcome back to Market Call. Brian Madden taking your questions. We'll go straight to the phone lines. Dan in Ridgeway, Ontario, calling in with a question. Hi, Dan.
Hi. I was calling about Cameco. bought it at April after the big, beautiful tariffs came in. And it's had a huge run. I was wondering if I should still hang on. And, Brian, I love that they used your voice in Ferris Bueller. Can you give me a Bueller?
Bueller.
It's good. It's good. Okay, thanks, Dan. Let's start talking about Cameco instead. What do you think about that company?
Was the question Tech Cameco or Cameco?
Oh, I don't know. I thought I heard Cameco, but maybe it was... Yeah, Cameco. Okay, sorry, we're just getting confirmation from the control room. It was Cameco.
Okay, gotcha. Cameco, big uranium producer. We own it. We've owned it for just about 4 years in our momentum mandate. It's primary uranium production, notably from 2 mines in Saskatchewan, McArthur River and Cigar Lake, and then they also have a joint venture stake in an in-situ leaching operation in Kazakhstan that's jointly owned by them and operated by Kazatomprom, the Kazakh state-owned mining company. And then they have uranium fuel enrichment capabilities in Blind River and Port Hope, Ontario. And the story got even better when they became even more further downstream integrated with the acquisition via joint venture of Westinghouse Electric. The other partner there is Brookfield Renewable Energy. And there's needless to say, a nuclear renaissance underway. The genesis of it was the natural gas that was powering Europe. Sort of the taps got shut off when Russia invaded Ukraine and Europe started rethinking energy security. So, we thought there could be a repricing of this from sort of a stranded, no comparables Canadian uranium mining company to a clean energy story. Because of this war in Ukraine. And then we got, more icing on the cake when the data center build out in the US really kicked off in earnest a few months after we bought it. And data centers, as was mentioned earlier, need always on power, which nuclear is just fits the bill perfectly. And it's clean and green, low carbon footprint. So we think the backdrop for uranium and nuclear power demand writ large is as good as we've seen in decades, to wit the fact that the United States is planning to fire up 3 Mile Island again after the psychological scars that nuclear disaster left in the 70s and mothballed one of those reactors for 50 plus years. Really tells the tale. Similarly, Japan, after the Fukushima disaster more recently, is starting slowly to switch its nuclear reactor fleet back on. So long story short, this is a secular growth story. Yes, it's a commodity producer, but we believe that this and some other commodities really do have a secular growth bent to them for all the reasons I mentioned. So we like this one, and it's 3 or 4x up from where we bought it, but we think there's still lots more ahead.
Okay, Roger is calling in now from Chatham, Ontario with a question. Hi, Roger.
Hello. Thank you for taking my call. I'm curious if there's an AI company that was being developed in Western Canada, Alberta being an example. What companies might they use in the construction of the physical buildings as well as the electrical grid? Because I understand they use a lot of electricity. Is there companies that specialize in Western Canada? Thank you for taking my call.
Okay, thanks, Roger.
Thank you, Roger. Lots. So the big beneficiaries, so there's lots of ways to play this AI and data center build out. The primary and most obvious one is the hyperscalers, so your Metas, Amazons, and so on. But I think what you're trying to do is sort of get upstream of they who are deploying the capital and invest in those who are booking revenues as a result of this big capital expenditure. So there's the electrical specialty companies. There's lots of those in the United States. But in Canada, we have engineering and construction companies. So some examples would be Atkins Realis, which I believe reported this morning. Or a better way, in our view of getting exposure to engineering and construction would be a WSP Global, which is based out of Quebec, but really is global in scope. And they are doing a lot of work in their power and electrical segment, I believe it's called, in data center build out, not just in Alberta, but globally. So that would be one to sort of put on the radar. And that, I would say, if there is contracts up for grabs in Alberta to build out data centers, There's no guarantee they're going to get it, but I would say they've got a good fighting shot at winning those contracts. But you've got a belt and suspenders approach here because they have a massive $17 billion order backlog, which is roughly 1.2 or 1.3 times their revenue. And it's diversified across different segments. So that would be one we'd encourage you to look at, and one that we, in fact, own in our momentum mandate at First Avenue.
Okay, we're going to take another quick break right now, but we will be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities right after this. Welcome back to Market Call. We're going to go straight to the phone lines. Bill in Toronto calling in with a question. Hi, Bill.
Hi. Thanks for taking my question. My question would be concerning the banking sector, the Canadian banking sector. I'd like to know your guest's outlook for that group. Thank you.
Okay, thanks very much. Yeah, after they all reported earnings this week, what do you think about the outlook?
Yeah, thanks for the question, Bill, and a very timely one. I've probably spent 15 or so hours this week parsing through the results of the 3 Canadian banks we own and peripherally scanning the ones that we don't. So our outlook is favorable. We look closely at BMO, Royal, and TD, which we own. All of those companies had good earnings. TD was probably the best of breed in terms of what their results showed. But Royal was also strong, and as was BMO, and they all have their own idiosyncratic strengths. But in a nutshell, it's a tight, well-regulated oligopoly that caters to a household and corporate need, not a want. They are diversified by geography in the case of the 3 I mentioned, Canada, the US, and in other global financial centers, diversified by line of business into wealth and capital markets and insurance in some cases. And so it all rolls up to a pretty good and clean line of sight through a cycle to a high single-digit rate of dividend growth, plus the current income you get from the dividend yields, which most of the time for most of the banks tends to be between 3 and 5%. So we like them, and we're overweight the Canadian banks. Okay, great. Amin in Richmond Hill, Ontario, also calling in with a question. Hi there, what's your question?
Hello, thank you for taking my call. Brian, what are your thoughts on long-term, let's say at least short, long-term, 2 years, on Meta, on holding Meta and waiting to ride out this AI scare? Thank you.
Okay, thanks, Amin.
Thank you, Amin. I think it's hard really to be bearish on Meta over the longer term. It's become ubiquitous and enmeshed in every aspect of people's lives to the point of addiction in some cases via their social media platforms. We don't own it at the present time, and it's not any particular knock against the company. It's just that we want to pick our spots amongst these magnificent 7 and these leading technology giants, and we've got better ideas within that group of companies, notably Google and Microsoft. So we're not buyers or shareholders in Meta at this time.
Okay, we'll take a quick break right now. When we come back, though, we'll take a look at some of Brian's new top picks right after this. Stay with us. Join us Monday on Market Call. John O'Connell will be on the show. He's chairman and CEO at Davis Ray and will be taking your questions on U.S. large caps. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms. And you can also watch full episodes on our YouTube channel. Okay, time now for Brian Madden's new top pick. So the first one, Brian, MDA Space. This is a company that seems to be getting a lot of attention recently as well.
That's right. To the moon, Lindsay, yeah. To the moon. So this is a company that's been around for a long time under different incarnations. It used to be called McDonald Detweiler and Associates, hence the acronym. Then it was taken private, and then it reappeared on the public markets a few years ago. But the long and the short of it is they make satellites. And so they're a leading space tech company, well positioned, we think, to capitalize on the large $1.5 trillion and expanding global space economy. Mm-hmm. And that's predicated on national defense modernization and deployment of next-gen telecom satellite applications. Their Aurora satellite, we think, is well positioned. It's got a competitive edge and cost-efficient, high production volume. And so as a result, MDA has an impressive book-to-bill, just under 3x, an order backlog of about $5.5 billion. And then more broadly, they see a pipeline of sort of early-stage nascent leads and opportunities on the order of $20 billion that they've nurtured and farmed through contacts with corporates and governments over decades. Stock pulled back sharply in the fall. That was after they lost their EchoStar contract, and rumors surfaced that the Globalstar contract was also at risk. Then they reported their third quarter results, and that helped shore up confidence in the stock, along with a trickle of other smaller contract announcements. They do report Q4 next week. We expect good results. More importantly, we expect an ongoing string of new contract announcements predicated on their leading technology and their incumbency in the business and the large addressable market.
Yeah, a lot going on for that company. Next up is Home Depot. What do you like about Home Depot?
So, I mean, this is obviously America's dominant home improvement retailer. They cater both to pros or tradespeople, general contractors, and do-it-yourselfers. They've been aggressively in recent years pursuing the pro clientele, and their edge is really being the go-to one-stop shopping proposition for complex multi-trade projects. And as a result, they've been taking share from their primary competitor, that's Lowe's, and also from a whole coterie of specialty suppliers, lumber yards, millwork suppliers, plumbing, HVAC, and electrical specialty stores. And they've further broadened their product assortment with some acquisitions. So a couple of years ago, they bought SRS, which is roofing supplies, and then they tucked into that GMS, which is another interior building products company. So it just extends their capability and the ability to be the go-to one-stop shop for the pro trade. They expanded a few years before that into the less cyclical repair, maintenance, and operations market. So that's sort of supplying multi-residential landlords, the hospitality industry, schools, hospitals, prisons. So a less cyclical business. And then, of course, the stepped up e-commerce capability helps them and really complements their very knowledgeable and expert in-store orange apron staff, as they call them. And all that is rolled up into a 13% compound pace of dividend increases over the last decade. We think the lagged effect of interest rate increases in the United States is likely to shore up housing in the coming year and bolster Home Depot's earnings and its share price.
Okay, last up is TMX Group, your last top pick. What do you like about TMX Group?
So TMX obviously is best known as the owner and operator of the Toronto Stock Exchange. That's what it was. That's not what it is. Through a string of acquisitions over going on 20 years now, it's now evolved into a multi-segment business that is operating equity and fixed income trading and clearing markets, derivatives trading and clearing markets, and a large and growing global insights and analytics business, which is quite differentiated because it's underpinned by recurring subscriptions and fee-based revenue. That is all translated into higher margins, higher returns on invested capital. This has supported an 11% compound growth rate in dividends over the last decade, a 23% compound growth rate in total shareholder return. The pullback of 20+% since midsummer is predicated in some part on fears of AI disrupting these global insights and solutions businesses. We think that risk is overdone. We see very good scope for a robust recovery in the share price at this level.
Okay, that is all the time we have, Brian. Thanks so much for coming in. Appreciate it as always. And thank you for watching Market Call. We will see you next time. Trading Day is next with Andy Bell.